Mr. Amarjot Singh Anand, founder Auro Digital Inc.
Very good afternoon to everyone present here. My name is Karan, and I'll be diving into the session straight away. So without any further ado, I would, first of all my questions will be open to the panel. I have no specific question for any one of you, so it's all out in the open. So let's start with the basics, right? So I would request if you could please help me summarize, let's say, the recent trends in the blockchain over the past few years, and any technological shifts as well that you may have noticed.
Sure. I'm happy to open. I'm Miko from Gumi Crypto's Capital, and I think the theme of the past several years has really been about increasing risk and reward. So I would say that the two biggest blockchains are, of course, the Bitcoin and Ethereum blockchain. And I think the biggest news on Ethereum is, of course, the emergence of eigenlayer, right? So the idea of liquid restaking or restaking paradigm is a way of getting more risk, but also more reward, right? And I think in parallel, what has happened in the Bitcoin ecosystem is the so-called Bitcoin layer 2, right? Which is an attempt for Bitcoin people to enter the world of staking, right? I think there may even be in the far future something like Bitcoin restaking, which will produce even more risk, right? And so in a way, the thing that I think this signifies is that we've been very successful, because I think that when people experience safety, they want more risk. And then when they experience the consequence of risk, then they flee back to safety. So I think the fact that people want more risk, both in Ethereum and in Bitcoin, means that Bitcoin and Ethereum have successfully delivered safety. So I think that that's really kind of my sort of very brief summary of the excitement. I think what people are waiting for now is mass adoption. And I think that one of the mass adoption vectors that everybody is watching today are the 900 million users of Telegram. So I think that that's another potential vector for mass adoption. So I think these are kind of the broad brush strokes that I would say characterize our current timing. I think the only other thing I would characterize is that we are seeing improvements in regulatory clarity out of the United States, and I think we've reached a tipping point where we've seen an end to the reign of terror of Gary Gensler in the United States as chair of SEC. So I think that that's something, I think his reign is ending, and I think we're going to see a new crypto-friendly regime regardless of the result of the upcoming US presidential election. Like, I think Gary Gensler's finished no matter what. So I think we're going to see crypto-friendly US coming soon. So I think that's the theme. And of course, we have ETF on Ethereum and Bitcoin. So that's my broad summary. I'd love to have any other panelists agree, disagree, or...
Yeah, sure. Let me follow up on that. And maybe let me throw some numbers. So if you think about when this whole movement started, that was... can you hear me? Yeah. That was, I guess when Satoshi wrote the white paper back in 2008. So it's been 16 years. So if we think about the trends during that time, and let's think about the infrastructure layer and the application layer.
Bring it closer. Bring the mic closer to you.
Oh, okay. And I think that Miko has made a good point in terms of thinking between risk and reward. So initially, a lot of work happened on the infrastructure layer. So you had, Bitcoin and then Ethereum. So you had these, layer ones. And then there was not that much development on the application layer. So even today, if you look back, the biggest use case in terms of real world for blockchain has been stablecoins. So right now you have about $5 trillion of stablecoins that were transacted last year, and it's gone up to about 23 million users. Other than that, in the early phases, I think blockchain was almost a technology that was looking for use cases. It was almost like solving problems that weren't really existing at the time. So if you think about the white paper, and I was at one of the big tiger funds, and when Bitcoin was initially pitched to me, it was solving two problems. It was solving the problem of inflation, so central banks printing a lot of money and that leading to hyperinflation, and then solving the problem of transacting money, so a medium of exchange. And on both of those, like I used to meet with the with the central banks of the G10 countries pretty much every quarter. And we had the reverse problem. They were trying to bend over backwards to try and create any inflation. So you had, central banks changing the lexicon of monetary policy by coming up with negative interest rates in Japan and in Europe. And you had helicopter money and all these new things. And on the medium of exchange side, there were so many mobile wallets from Google to Apple to Samsung. So it almost was solving some problems that didn't exist. And now you're starting to see inflation sort of coming back. So as an inflation hedge, it's become a hugely important asset. And now you're seeing the real world applications of that coming in. So right now, we think there's about $5 trillion of applications currently in terms of non-stable coin uses. And we see that growing to about $25 trillion as early as 2030. So, I think that sort of can help you dimension what that sentiment is like.
So it's interesting how you brought about, speaking about regulations, India is also maturing as a country for blockchain, right? So what exactly do you feel is the role that the investors, be it institutional, be it an angel, anyone, what is their role in, let's say, preparing the particular startup to be out there, be compliant, most importantly? That's one of the challenges that startups face, right, in terms of investments.
Yeah, I think I'm the MD for Brink. We invest really early, pre-seed stage, where we have a hands-on approach, and we work with the startups through the investing cycle. We obviously look at the market potential, the business model, the technology, the innovation, the team. But legal and regulatory compliance is something which we also take a hands-on approach with the startup.
I think that compliance is actually the least of our worries. And I'm a contrarian on this because I believe that, for example, in Japan, there's regulatory clarity, but there's very thick, heavy compliance and regulation. But what's happened is actually that AI technology is improving companies' ability to digest and comply with very complex regulation, right? Because it's able to really coordinate and digest and create a framework for action. So I think even heavy regulation is clarity. And so I think, places like Japan are in a strong position. And I think that actually I really appreciate your comment about inflation, because we actually believe that that's the fundamental exponential driver, right? Which is ultimately that the disruption and dislocation is really coming from the bank balance sheets of central banks around the world. Bank of Japan being like probably the worst offender, right? It's extreme.
Yeah, I think globally, if you think about it, you can divide the entire world into 3 buckets of regulatory advancement when it comes to blockchain. So let's think about Europe, the US, and then some of these more enlightened regimes that have really been progressive and visionary, like I'd say Japan, Singapore, Hong Kong, Dubai. And so if you think about it in that framework, I think the US, and Miko's probably right, so I think Gensler's probably on his last legs, but they have basically followed a policy of regulation by enforcement.
Terrible.
So instead of working with startups, instead of working with companies and trying to understand and proactively regulate the space, they've just been issuing cases and closing down companies and making fines and imprisonments left, right, and center. And what that's done, and I think India is in an interesting sort of crossroads right now, is that the US lost a lot of talent that essentially fled to Dubai, fled to Hong Kong, fled to Singapore. And now they're realizing it's one of the few things in the US that both the Democrats and the Republicans agree on. There's very few things. And this is one of them, that they now need to bring that ecosystem back because they're losing a big war. And stablecoins, while the Federal Reserve was really pushing back against that, they've realized that that is the best way of importing dollars in the world. It's better than petrodollars. It's better than transaction payments. And so, they're now going to become much more regulatory, I think, proactive towards blockchain. I think with India, it's been a tale of 2 cities. I think they've been pro-blockchain, and there's a national blockchain, council and committee that's trying to sort of improve blockchain. But they've been pretty ambivalent and, borderline hostile to cryptocurrencies. And so we have also driven out some talent to places like Dubai, et cetera, that we need to bring back. And so as an investor, we kind of have proactive dialogues with regulators in all of these countries. But the startups themselves, they have to be compliant. And if the rules are unclear and hostile, they're going to find other places to do business.
Yeah, and just to add, so we have startups, so many projects in India which are domiciling either in Dubai or Singapore, right? And they move there because of the regulation, because it's not clear here. So and they're all Indian founders, projects for the Indian market, Indian founders, but they domicile outside.
I think you had a point to add, probably.
Yeah, I did want to say, just taking the bull by the horns, like you really were asking the core question, which is what is the role of investors, right? And I think that we really have to pay respect to Adam Smith and the invisible hand, which is that the role of an investor is to route capital to the place where it can be best used, right? And I think in some ways, shame on us, right? In the sense that investors, like, there's just famous scenes from like Sequoia Capital investing in Sam Bankman-Fried while he's playing League of Legends, right? And it's just, definitely the investor base has invested in a lot of foolish nonsense, right? So like, obviously the investor community needs to do better diligence and needs to obviously like, my esteemed panelists are doing the hard work, but I think that, as an industry, we definitely need to route the capital to the best places where it can be used, not just silly things.
Yeah, I'll add on to that. I think this is one area in which the institutional investors really need to eat some humble pie. So I missed it early on. I think it was retail that has grown this industry and brought it to a level that it's just too big to fail. And now, folks like Larry Fink, at BlackRock and Franklin Templeton and all these guys are sort of coming on board. But it's really one of those movements in history where retail saw it. It really kept pushing it. I mean, the number of obituaries that have written about blockchain and crypto is probably more than any other asset class. This thing has died and then come back. And now I feel we're at a place where not too many, even moderately smart people question the if part of this. Now it's about when and how big it becomes and how quickly you get to mass adoption.
Got it. So my next question here is, so I'll just share a small experience from my end. So from my time in venture capital, I have learned that listening to different ideas, listening to various perspectives is extremely important. Really helps keep the mind open. So from you guys, I wanted to understand the importance of an investor's role. Of course, capital infusion is a very primary activity. But apart from that, what other roles do you think an investor can take to, let's say, help a startup or the ecosystem in general?
Yeah, I think that the role of the investor also depends on the stage of the startup, right? What is the stage of the investment? What is the stage of the project? Is it early stage or is it later stage? The role will definitely differ depending on the stage they're at.
So I want to contribute actually one of my venture capital heroes in his words, which is Vinod Khosla, who said that 90% of VCs add zero value and 70% of VCs add negative value, right? And his criteria was as follows, which is Vinod Khosla said that you have to study the career history of the VC, and you have to ask yourself, what right does this person have to give any advice at all to an entrepreneur? So to me, when you do look and scrutinize, and I'm definitely willing to, self-reflect as an industry, and, I think we need to examine, ourselves and ask that question, because I do think that, obviously, we want excellence across all spectra, including the venture community, as well as, of course, the entrepreneur community. But I just want to reflect on what Vinod has said, because it's a pretty impactful and critical view.
So we're also open to hearing any mentorship stories that you may have to share, be it your personal or somebody else's. That will, I'm sure, be very helpful to all of us.
Well, maybe I can try and take that. I don't necessarily have a mentorship story, but we've taken a novel approach in terms of, especially for digital assets and crypto and blockchain, how we are sort of approaching the investment problem. So, on what I call the TradFi side, so the sort of the non-crypto side, we've invested, globally in, across, companies like Uber and Palantir and, here in India, and Flipkart, Gardeko, et cetera. But on the crypto side, because it's quite nascent, especially in India, we followed more of a venture studio approach. And we find that that is quite helpful. It's also much more novel and differentiated because also VCs are in some ways there's so many VCs now and angels, and I mean the whole space has become quite crowded. So it's hard to comment qualitatively on what is a helpful VC versus a non-helpful VC.
I think one area that's really important is specialization. And I think for us, Gumi Cryptos Capital, like we've been doing it enough since 2018 that we have 650 venture class co-investors, right? So a lot of what we specialize in is actually bringing our portfolio companies to other investors. For example, like the case of OpenSea going to A16Z, or Yield Guild Games going to A16Z, or these other kinds of like mechanisms where we kind of help to handle things like venture up rounds, right? Because what I mean by the specialization is that we kind of have to know our limits, right? Like we have to know what it is that we're able to do and what we're able to specialize in. So I think that's one of the specialists that I have, it turns out, is I have some years of experience in go-to-market and CRM implementations. So one of the things I've been building is a CRM data sharing platform, right? So what happens is that our portfolio companies actually get access to kind of a shared CRM so if they're doing B2B within Web3, that they all kind of collaborate and synchronize on primary contact information throughout the industry. So I mean, we definitely do have certain specific narrow areas where we feel we want to uniquely add value based on the backgrounds of the partners. But I think that, we definitely don't want to have overly broad ideas because, we want the entrepreneurs to be the leaders.
And
yeah, I'd agree with that. So, you have these horizontals at a VC where you can help just generally across legal, regulatory, capital raising, business model. But then I think the most helpful VCs are ones that are domain sector focused. So you have certain sectors of excellence where you have domain expertise, where you can truly add value to a startup, and you try to focus on those and not on the others.
So my next question is a very interesting one. So a couple of years ago, India had a D2C wave where a couple of D2C startups made it big. So we had a lot of D2C startups in India arising. So my question here is, how do you deal with startups that are wanting to chase, let's say, any short-term trend compared to a long-term? And how do you observe them, and what are the kind of conversations you have with the founders then?
Yeah, so I think this is a big topic, which is short-term versus long-term. And part of what we do is, in our discipline, we're very, very centered around the motivations of founders. And we really are looking for things like founder market fit. And so part of our philosophy is to really try to make sure, and we study the backgrounds of the founders, right? Because the average Data Collective has research called Super Founders. It's a wonderful book, and they basically say average time for a Web2 unicorn is 4 to 7 years. And we actually have a philosophy in our firm which we think of as peak to peak, which is that we have basically like a Bitcoin 4-year cycle. So if you think about peak to peak, what happens is you can have a company with a success, and then you can actually have potentially an exit on the next peak, right? So it really means that these companies have to have endurance. So in a way, like, I think people who are opportunists or who are like chasing a fad or a trend, right? Like someone who shows up who has no background saying Web3 plus AI, it just doesn't impress us at all. So, I think we really want to see people with really deep founder market fit, deep motivation, and kind of passion and conviction, conviction to stay and to do the work.
So with that, how do you guys, let's say, evaluate a startup? I mean, you mentioned that it's very hard to evaluate an early stage startup, right? And as you rightly mentioned, how can a VC tell you how to run your business? So how do you guys really evaluate, and what are the kind of red flags that you look for in a startup?
Yeah, I can take that. I mean, it's not that different from when you're investing in TradFi companies as well. So it's obviously, as Miko said, it's the team. It starts off there. It's the founder. yeah, founder market fit, I think, is a great idea. In addition to product market fit, their execution capability, and then it's about the tech, right? Is it truly solving an innovative problem? Is blockchain just applied because it's a fad right now, or is it truly something that can't be solved by Web 2 and you need blockchain? Is it scalable? So you think about transactions per second, you think about finality, you think about, are they using, what kind of gas fees? Is an L2 rollup? Is there any other consensus protocol? You think about security, right? Is it easy to hack this thing? And then in terms of the blockchain side, then you also have to think about regulatory and compliance, because that's potentially a big red flag. And then in a lot of cases, you have to think about tokenomics. Is it just capital structure arbitrage? Meaning, like, is it just right pocket, left pocketing your equity capital structure? Or is the utility token something that has a real use case in terms of customer acquisition or governance? And how is the token distributed? Like, is it going to be a quick dump even by the VCs and then you kill the company? So to think about the longevity of the token economics. So those are some of the more, I think, idiosyncratic things you think about when you invest in a blockchain company.
Yeah, I mean, responding to tokenomics, like, I think one of the really big tells is short vesting, right? So if you see short vesting, and to me, like, short vesting is a disease that companies and founders get, but it also is a disease that comes from investors as well, right? So if an investor is asking for short vesting, it's basically everyone should be suspicious, right? Because if they're asking for short vesting, it's sort of, who are they planning to dump on, right? So in a sense, like, you need to create equitable and aligned structures, and you definitely want to make sure that you're dealing with the right investors with the right motivations. And I really feel like Silicon Valley invented the 1-year cliff, 4-year vesting structure, and I definitely want to. People are like, oh no, it's tokens, 6-month cliff, this kind of thing, and I'm still against it.
And so what do you guys see as a long-term vision for blockchain investments, and any segment you feel could potentially become a backbone, let's say, in the future?
Well, I mean, if you think about it, it's got to be real-world assets, because that encompasses so many different things, right? So you start off right now with tokenization of money markets, treasuries. You've got stable coins. But then if you think about it, like, majority of the assets in the world are still illiquid. And so, in addition to being able to take out the intermediary costs of the rent seekers that have crept into a number of value chains, we think about a world, which is why the tagline of Auro Digital, which is one of our flagship investments, is the world's gateway for digital assets. We think that every asset could essentially become a natively digital asset, where you can fractionalize it. So you're starting to see use cases that are real estate, infrastructure, renewable energy, and many others that decentralized compute, storage. All of those things essentially can become tokens and become much more efficient. So that's the future we see.
At the risk of being a little too trend happy, I do want to say that something fundamental has happened in an inflection point, not just in technology, but actually in human history, which is that we really now have very profound emergence of GPT, generative pre-trained transformers, and I think that this actually will have a very profound impact on every industry. I think that really specific verticals that will be very impacted will be the legal profession. I think compliance will be very impacted. I think we'll see impact across things like sales or CRM software. I think will be largely automated. So I think that every company in the world will now have custom software. So I think that this is actually going to be a pretty seismic impact to the global technology industry. I think people, I guess the cheap way of calling it is AI, right? But I think that really, I think the thing that has happened that's new is more like GPT, right? So I think that, because of the Transformer paper by Ashish Vashwani and et al., I think it's really going to be a game changer with respect to every industry.
So now my next question is that blockchain is also referred to as a tool that can be used for social good, right? So how do you draw a balance between profitability and, let's say, creating that social impact? It's a hard choice to make, right? So how do you guys deliberate that?
Well, I think at its ethos, I mean, what drew me into, into blockchain was the Web3 aspect of it. So, it's the first time you have a protocol that incentivizes both sides, so the users and the owners, in a way that you don't create these monopolies and duopolies like you created in Web 2. You can create more decentralized economics where the users of a platform can benefit economically and can also participate in the governance of that platform. And I think that is a very powerful idea. And that allows for financial inclusion. You can apply it to so many different industries. But at its heart of it, which is why the initial phase of development of crypto was a bit unintuitive. Like and even today, 90% of the liquidity is still in centralized exchanges with, where you have these central, points of failure. The whole idea of this movement was to decentralize. And so I think DeFi is very important, and we're now getting, a good momentum behind DeFi. But at its core, decentralization allows for financial inclusion, which is socially good.
And I think the whole point of Web3 is that it allows for network effects, right? Across networks and across platforms. And if that comes into play, then that ensures equality for everyone.
I think that really there's a lever that's much bigger than blockchain, which is abundant, clean energy. So if energy production becomes sufficient, and right now we're seeing lots of new nuclear plants coming online to handle things like 5 gigawatt data center facilities for AI. So AI is actually so strong that it's driving energy production. So the tail is actually wagging the dog. But if we get enough energy production online, then we can actually have abundance, right? So when you see things like AI automation driving down the costs, and in a sense, the question becomes whether we create an abundant society and we actually have room and capacity to enjoy a whole plethora of dimensions of value beyond just subsistence and greed, right? I think that the biggest lever is energy production. So if we have abundant clean energy, I think we build a fairly utopian society, right? But if we don't, so to me, to answer your question about how do you deal with impact and public goods, I think that the lever is actually outside of our industry, which is, if we have the energy to create abundant society, then things will go well.
All right, so we have a couple of minutes before ending the session, so we can take any questions from the audience if anyone has. Could we please
Here's
pass
one.
the mic?
Yeah, hi. Very good afternoon to everyone. And I have a small query here. So how have investors' priorities shifted over the years in the blockchain space, and what impact has this had on the evolution of the ecosystem? When we look at over a period of years, currently 24, and from maybe 10 years back, how the things has evolved.
The priorities have shifted.
Yeah, I'm happy to comment briefly. So, really in regards to how have the priorities shifted, one of the biggest shifts has been the migration of the attention from infrastructure up into the application layer, right? So I think that for the past probably years, there's been a huge focus on building adequate infrastructure, especially for things like scalability, identity, custody, right? So there's many, many layers of value that have been accrued, but I think now the priority has shifted towards applications. And I think if we don't, Vitalik Buterin said, if we don't have mass adoption applications in the next 5 years, the whole thing is a failure.
No, I would echo that entirely. So, you've had a lot of investment in the infrastructure space, and you had instances like DeFi Summer where you got too much euphoria, and the infrastructure did not keep pace, and so you had a bunch of hacks, and then we had to pull back. And now you get a sense that block space has become relatively commoditized. Like that is not a constraint anymore. One of the big trends in the ecosystem, which Sandeep's also working on, is now getting interoperability of all of that block space. So getting these chains to natively talk to each other rather than going through clunky, expensive bridges and then bridging back. But we're kind of getting there on the infrastructure space. So now the focus is on the application space, on seeing real world mass adoption.
Yeah. Thank you. Thank you, sir.
We can take one final question in case anyone has. Could we pass the mic to the gentleman behind?
Hello everyone. I know most of you actively invest in startups, but in one point of time you must have raised funds for your own company. So being a founder, how can we negotiate a perfect deal from the investors?
I think there's no. I think it's as being a founder, we set up BharatBox, being an active VC investor, took an operational role and set up BharatBox, which is a joint venture with the Sandbox, right? And there's nothing such as a perfect deal, right? It's all about what's right at that given moment at that stage of the company, and it's not about maximizing the valuation. It's more about getting the right amount. You need to get the right amount of money which you need for your project. So defining what is the funds which you require and what is your runway going to be after that is the most important.
Thanks. Thank you so much. So now I would like to move towards closing this session. My final question here is to, again, all the panelists, your advice to founders and also on what you feel on the emerging trends and which problems you feel that founders should primarily, start working on.
So as far as which problems the founders should work on, I think there's two qualities, right? The one quality is that they should work on the problem that they have the most passion for, right? So it really comes from within, this kind of burning passion, that's really the thing. But the problem is this, right? Which is, to me, they also have to find the pain and dissatisfaction in the market. So I think if you take a page from Bhagavad Gita, it's like you have to have Svatdharma and Sanatana Dharma, and you have to kind of connect this individual Dharma with the universal Dharma, right? So I think that this is really how you choose the problem that you solve, right? So one of the ways I look at it is dissatisfaction. So an individual entrepreneur has their personal dissatisfaction. If you look at Elon Musk, he has huge dissatisfaction, right? If you look at Steve Jobs, he has huge dissatisfaction. But they're able to take their personal dissatisfaction and connect it with the universal dissatisfaction, right? And I think this property is unique, and I think that's how you solve problems and you really connect with the problems of the world.
Yeah, it's hard to top that. That's brilliant. Yeah, I think if I to put it more in VC speak, you need to find a good balance between founder market fit and product market fit. You have to be passionate about the problem you're looking to solve, and you need to have some domain expertise in the area you're looking to solve. So you can't just pick a trend because it's hot. And yeah, finding a pain point which may have resonated with you also makes the whole startup and the VC pitch much more authentic. So for example, with Auro Digital, our hedge fund was running an algorithmic crypto strategy, and we needed to find a digital order management system and portfolio management system, which kind of led us down the path of then acquiring this and partnering with Broadridge, which is a TradFi market leader in the space. So it was a very authentic pain point we had. We tried to solve it. and then we seeded it, but then we're now able to raise money from other venture capitalists as well. So I'd say those are my thoughts. Would you like to add?
Yeah, I think the most important is the team, right? If you solve the problem of your team and alignment of all members of the team in a fair, equitable manner, right? That is solved, then all these rest of these problems can be taken care of.
Everyone, I again thank the panelists with me here, and I thank the audience as well. Thank you so much.